Hello, everybody. Welcome to the channel. This is Fair Value Finder, and today we're looking at KeyCorp, ticker KEY. They had earnings, and we're going to take a look at the 2022 year-end numbers, find what the value was at that point, and see how the recent earnings have impacted the valuation of the stock. So, of course, we're going to start with the chart, just see what we're looking at, what the market sees with this stock. To some of you, it's just a whole bunch of lines, but what we're looking at here is recently, since about 2016, 2017, we've just kind of been trading in a range somewhere between the $14 and $20 level, and it's been bouncing around in there. Today, it broke down below that after the earnings, which came in lower than expected. As we can see up at the top, the stock is down over 5%, and this could pose a buy opportunity. The market might be overreacting, and we're about to find out whether that's the case. So we see as of the start of 2022, the end of January, we've just been on a downtrend with this stock. And the whole banking crisis with Silicon Valley Bank has dragged this stock down pretty quickly. I bought into this stock quite a while back, and I really liked it. I thought that the fair value was in the $20 range, so I was buying it up around 15. Loved it. It got up to 20, so I sold a put position, and when the Silicon Valley Bank situation happened, it plummeted, and I got assigned on that put. So I currently hold 170 shares at a rather hefty average cost in the $16 or $17 range. So I'm down about $5 a share on my position of 170 shares, and that's why this here is very important to me to figure out what's going on here. Why did the earnings come in so low? Is it worth just cutting my losses, or is there a possibility it'll recover and I can make that money back? So we're looking at a long-term upwards trend since the previous financial crisis back in 2008. The stock plummeted from almost $40 all the way down to $5, and it's just been bouncing off this trend line continuously. Even this recent drop, it touched the trend line, which means there's some support to the stock. I think that we might see a little bit of resistance as it makes its way back up towards $13.50 to $14. It might be a little rough, but once it breaks through that, as we can see, typically it moves up pretty quickly over the course of a month or two. It moves in that range, both up and down. So that's all we need to look at for the technicals. Let's move on to the 2022 year-end financials, and then we'll look at the most recent earnings. Here we are looking at the 2022 year-end numbers. Financial stocks, banking stocks are quite a bit different than what we saw on like an AbbVie, because they're not developing a product and selling it. They're collecting deposits and loaning that money out and making their profit off the spread. So there are some lines here that I just don't have necessarily information for. As you can see, cost of goods sold is blank, the gross profit is blank, EBIT is blank, gross profit percentage is blank. I do have a net profit, which we can take a look at. But to get started, we have a top line revenue with a 4.4% 3-year compound annual growth rate, moving from 6.2 to 7. That's pretty good. As I've said before, I like to see that closer to 5 to 10. This last year, they were pretty stagnant, a very small drop of $5 million. which that's nothing, just stagnation. Their net income, it has trended down 2.2% compound annual growth rate. This last year alone, negative 27.3%. But as we can see, 2021 was pretty high in comparison to the others. So they had a good year in 2021. We need to see this turn around. We don't want to see the top line growing and the bottom line shrinking. So that is something to watch out for. Expenses, their expenses have been trending up since 2019, up 4.5%. This last year, they did drop their expenses a little bit. So there was a rather large jump from 2019 to 2021. That's another thing we want to keep an eye on. We want to see this downtrend continue in the expenses. The net profit has been declining. That is a huge red flag. It has been declining at a compound rate of 6.3%. This last year alone was 27.3%. Rough, moving from 6.8 to 5.6. Again, 2021 was a good year for them. 2022, not so much. We'll have to see what 2023 brings, but with the year starting with a banking crisis and many depositors pulling their deposits from regional banks, smaller banks, such as Key, it might be another rough year for them. Asset-wise, as we can tell, they're really heavy on assets. They, of course, have a lot of cash from deposits. They have 9.4% annual growth, almost 2% in the last year alone, moving from 145 billion to 190 billion. That's a nice trend we like to see. Liabilities have also been growing, though, but at a faster rate. Of course, they're loaning out a lot of money. Assets, actually, what they're loaning out they'd consider an asset, and the liability would be the deposits that they hold because they owe people interest on that. That has been growing 11.3% compounding, 4.4% in the last year alone. That's not a good trend that we see there. The liabilities are outpacing the assets, and that's why we see a declining book value. Compounding 12.8% down, and last year alone was down 36%. That's another red flag. The free cash flow for the stock is good, actually very good. This last year was an anomaly, though. They made a lot of free cash flow in 2022. I think a lot of these numbers come from acquisitions of smaller banks, and we'll have to see how all of that plays out over time. But 15.6% compound annual growth rate. They 3x'd in this last year alone on their free cash flow, which helps them grow their dividend, which we'll get to later on. The share count declining a bit over the last 3 years, down 1.8% compounding. They grew it a little bit this last year. I've already taken a peek at the earnings, and you can see the 3 quarters that they show an increasing share count, which if you see my other videos, you know that is a massive red flag to me. That's not what we want to see because they're diluting our positions. We'd like to see them buying back shares. Shareholders' equity has been dropping. This one we could actually take a look at. Compounding down 10.2%. That is not good. This last year alone, down 29.4%. Definitely not good. They need to change up a few things. The dividend, though, they have a strong dividend, $1.30 at the moment. Compound growth on that is about 10.3%, 10.2% this last year alone. That's what we like to see, consistency there with the stock chart as well. This is just a dividend stock. This is not a growth stock. This is something you hold on to and you get paid to hold on to. And that's that. You just watch it trade in a range, get paid. If you own 100 shares, sell some covered calls against it. That's what I did with the drop today. I made $20 because I had a covered call that was open. The return on equity, as I've said before, we're looking for something at least above 30. This is awful, but it's a bank, so we're not expecting something massive. Bank stocks are not something that I typically mess with. I got into this years back, and I've been waiting to see it in the $20 range. Once it hit it, all of a sudden there was a financial crisis and it dropped. So I wish I had sold out, but I didn't. So now I need to ride this. With all these red flags, I would not buy more. I mean, even my valuations, I still believe end of 2022, it was at least a $20 stock. They had earnings of $1.92, which with a 20 PE, we'd be looking at a share value of 38.6. But financials don't trade nearly that high because there's not a whole lot of growth in them. For the book value per share, again, this is based on loans and deposits, so the book value isn't really a good measure for my financials either, but we're looking at something in $25 to $26. The free cash flow, this, as I said, 2022 was an anomaly. So if we change this formula and look at 2021, we get a much better picture, which gives us $23.35 a share. And then the dividend, for the dividend that it pays, I'd be willing to pay up to $37. So that's what I keep saying is it's a very strong dividend stock. They pay a healthy dividend, they can afford it, and they can grow it. So if that's what you're holding it for, that's what I originally bought it for. It's not bad. Especially buying it at today's prices, as long as the earnings are good and the stock can turn around everything that's marked in red here. So speaking of earnings, let's get into those. We're going to start with the financial highlights. So they're showing us numbers for Q1 2022, Q4 2022, the last quarter, and the current quarter, moving from right to left. So net interest income trending up from Q1 2022. I mean, it's up this year, down from Q4. We're not going to look at every single one of these numbers here. You can find this on their website, their investors section of their website. Here shows the 30 cents per share that they had in earnings, which was significantly lower than what was expected of them. And that is why we see such a huge drop in the stock. If I go back to the financials, I project out that with their 30 cents per share that they had in earnings this last quarter, this current quarter, that'd be $1.28 for earnings on the year, which is down 70 cents per share from last year's earnings. And if we take this, analysts currently project that the or the earnings for 2023 will be $1.73. But if we drop that down to the 128 that it looks like they might come in at based on low earnings and last year's weighting, we'd be looking at a $25.6 share price for that PE of 20. But again, 20 is a little high for financials. So again, I mean, everything is showing me it's about a $20 stock. At least as of the end of last year. So now we'll go back to the earnings, and we see that 30 cents, it was 45 the first quarter of last year, down 50% year over year. The last quarter was only 38, so that's a lot closer to what we got here, which is showing just a downtrend in earnings total. Here are all the performance ratios, but what we really want to get to is all down in here. Consolidated balance sheet. Let's start with the balance sheet. So as of right now, they have total assets of 197.5, which is up from the previous quarter. And they have a total liabilities of 183.2, which is also up from the previous quarter. And we can do some quick math on what that is. So doing some quick math, we're looking at a asset growth of 4% and a liability growth of 3.9%. So essentially 4%. Assets just north of 4, liabilities just south of 4. Assets are outpacing liabilities, but we want to see those liabilities downtrending, not uptrending. The total equity of stock is up. Total liabilities and equity. Oh, here's the key shareholders' equity. So it's down from a year ago. It's up from last quarter. Interest income. On loans, they are making more money. That's been trending up quarter over quarter. Loans held for sale, that's higher than last year, lower than last quarter. We're not going to look through all of these. Total interest income trending up. That's good to see. It's up 800. No, not quite 800 from a year ago, and up 100. These are all in millions, by the way, from last quarter. Interest expenses on deposits. I mean, that's trending up an insane amount. It's almost nearly doubled in this last quarter, their interest expense on deposits. So that shows you the rising interest rates, and they're paying out more on their deposits. Total interest expenses is up significantly. Some quick math, it looks like. Oh, here they do it for us. Yeah, 1.1. Very close to flat on their net interest income. I mean, it's down from last quarter. And their per share, cash dividends per share are up, as we'd expect with some growth. We're just scanning this, looking for red flags at the moment, or green flags. And here's a breakdown of all of their assets. When I had peeked at this, I had noticed that their commercial is starting to outpace their consumer, which is probably a good thing. We'll see how that trend continues. Yeah, here's that breakdown of the total assets. We're not going to look through all that at the moment. This isn't going to be an hour-long video, but I will scan over it myself to see what's going on. Where do those extra assets come from? Where do those extra liabilities come from? Here's their expense reports. Salaries and contracted labor. That's growing at a very quick rate. Incentive and stock-based comp, that's going down. That's nice to see. Employee benefits stagnant. Severance is up a lot. Layoffs are hitting companies, and that's going to affect that number. That's why the total personal expenses are up, or personnel expenses. Computer processing is declining. Professional fees, right? No. Net occupancy is declining. Computing processing is climbing. This is declining. Business services and professional fees. Equipment bouncing around. Operating lease declining. Marketing declining. Other expenses raising. Total expenses are climbing and slightly up from last quarter. Just slightly. Yeah, let's look at their real estate exposure. Commercial and industrial loans, commercial mortgage, residential mortgage. So it looks like they have 38 billion. $38 million in mortgages. So about a third of their total loans are real estate. And the important bullet points are at the end of these pages. So like right here, they say during the first quarter of 2023, Key declared a dividend of 20.5 cents per common share. Additionally, they have $752 million remaining in share repurchase authorization through the third quarter of 2023. So they plan to be buying back shares. We should see that share count decreasing throughout the year, which is something that we want to see. Like I said, one of the red flags was there was a small increase. It could have just been preferred shares being converted. It could be their stock-based compensation. But that's something that I like to see. The important ones, I think, were down here. Yes, Key's Consumer Bank recorded a net income of $81 million in the first quarter compared to 71 a year ago. So consumer banking is growing. Average deposits decreased $7 billion or 7.7% in the first quarter, driven by elevated inflation-related spend and normalization of pandemic-related deposits and changing client behavior due to higher interest rates. So they're saying that people are saving less money because of inflation and higher interest rates. So they're not putting it in the bank. They're going and fetching a return elsewhere, or they're spending that money on their needs because they have to spend more. Which, I mean, we know that's why the economy is so choppy right now. That's why the Fed is raising those rates to help fight inflation. And banks are going to be the ones that get hurt from that kind of situation. We're seeing that through all of this, the collapse of a few banks recently and the drop in deposits that Key is seeing, because down 8% in deposits, that's 8% that they can't loan out and make a return on. And so we might be looking at a lower quarter two as well. Non-interest income decreased $28 million from a year ago, driven by a decline in service charges on deposit accounts, reflecting on a planned reduction in overdraft and non-sufficient funds fees. They made $28 billion on just fees on their accounts. 28 million less. That's insane. Non-interest expenses increased by $12 million, 1.8% from a year ago, primarily driven by an increase in salaries, which has to do with inflation. Let's see, what else do they say? Net income, $264 million in the first quarter compared to the $284 million a year ago, down $20 million, 10%. That's it's not really what we want to see, but with the decline in deposits, that's kind of to be expected. Taxable equivalent net interest income increased by $61 million or 14.7% compared to the first quarter, reflecting higher interest rates and balance sheet mix. These interest rates are hurting banks. Average loan and lease balances increased $11.6 billion to 18% compared to the first quarter of 2022, reflecting growth in commercial and industrial loan and an increase in commercial mortgage real estate loans. So they're still seeing a hot real estate market. Average deposit balances decreased $5.1 billion compared to the first quarter of 2022, reflecting elevated inflation-related spend. We've already touched on that. Provisions for credit losses increased $30 million compared to first quarter 2022 as we prepare for more challenging economic conditions. Even the Fed said that we're looking at a recession come Q3, Q4 this year. Non-interest income decreased $28 million from a year ago, primarily driven by a decline in corporate service income and lower investment banking and debt placement fees. $14 million increase in non-interest expenses driven by an increase in salaries and compensation. So what are our thoughts on this? I think banking is going to be a tough sector for the next year. If you want to buy stuff up while it's low, this might be your shot on key. We are looking at even a decline of 10% that we're looking at across a lot of these numbers. If we did say that the share price was $20 previously, you'd be looking at an $18 share price, which is $7 lower than the current and is a rather hefty return. I mean, $7 a share on an $11 investment is $64%. So there's a lot of risk here, but with risk comes reward. Be greedy when others are fearful when others are greedy. I'll probably take my 170 shares and just make it 200 shares, sell a second covered call as I ride this out and watch it, because the dividend is good. We can do a search and see where dividend is mentioned. Cash dividends declared. Cash dividends per common share. Okay, they don't say anything about a cut or a raise. How many times do they mention inflation? Three mentions of inflation. Decline. 14 mentions of decline. Growth. 7 mentions of growth. And they're talking about certain sectors that are growing. Slowing loan growth. Okay. So they're not expecting a very pretty year this year. How does this affect the current share value? I mean, I think we'd be looking at a 10 to 15% cut based off these earnings alone and what they're saying. They're not expecting a very good year. So like I said, I mean, we'd be looking at maybe something closer to the $15 to $20 range rather than the $20 to $25 range. but that's up quite a bit from where it is now. So the risk is yours to take. That's what I think about it. I'm going to be buying another 30 shares because I think it's a bit of an overreaction with the huge sell-off that we're seeing. But we'll see how it plays out, and I'll keep you guys updated. Thank you for watching this one. I'm also going to be coming out with an AT&T video hopefully today because they had their earnings too. And I'll catch you guys next time.